Hey there everyone, it's Joe from Ainsley's Gold Silver Standard Insights, brought to you by goldsilverstandard.com and ainsleyBullion.com.au. Today's topic is non-farm payroll, NFP, does nothing to allay US recession odds. Brace. Now that was posted on the Ainsley website. I'll put a link below for you to follow along. And of course, we have Chris Tipper here to break down the morning's news. And joining Chris today is Tim Kent from Kent Private Wealth. We've had Tim on the show a number of times before. Now he is a licensed financial advisor through Cyra Group, but still anything he says today, of course, cannot be constituted as financial advice, but you already knew that. So Chris and Tim, over to you.
Thanks, Joe. On the last Insights back on Thursday, we were looking at the potential for good news from the non-farm payrolls on Friday night to end up being bad news. And that was exactly what unfolded, with the unemployment rate in the US falling, leading to a broad-based market sell-off. We've seen this pattern play out on repeat for the past several weeks, as any stronger than expected data are seen to give the Fed the justification it needs to keep raising rates for longer into the future. With the upcoming CPI inflation numbers this week and markets right back on the brink of testing those lows, the potential for something significant to break seems very high. So to get some perspective on all of this, we welcome back Tim Kent from Kent Private Wealth, who always has his finger on the pulse of the markets. Thanks for joining us again today, Tim.
Hi, Chris. Thank you. Nice to be joining you.
So let's dig straight into that number on Friday. So what did the jobs number tell us about the state of the US economy?
I thought it showed that the economy was still relatively strong, and obviously there was more jobs still available, and companies are still employing. But I would argue that we're getting sort of near that might be the last good report. I think from now on, I think you'll see. I think it'll continue to roll off. The economy's slowing. Employers are starting. You're seeing companies putting off workers starting to accelerate in the US. So I think this is a bit of a residual of a tail of the employment, because they have gradually been paring down. So yeah. I think this is the last of a good one, and I expect them to slowly deteriorate.
Just on that, the job openings that came before that, they were sort of telling us that, weren't they? That it was actually falling off. Is it just that lags? Is that what we need to take into account here?
I think so, or the gap is still so high with so many vacancies still available. Like they are coming off, that's correct. But don't forget there was a significant amount of job vacancies relative to workers at that time. So I think they are coming off, correct, absolutely. But there's still that gap. If you look at charts technically of the gap between vacancies out there, they're still there, and they're still, but they are trending down as well. But there's enough, obviously, vacancies out there. And people now, obviously, you can see with those credit numbers that people have got to pay their loans off. So they're probably trying to go for any job they possibly can, or have multiple jobs, from what I'm reading, that people are taking on to try and service their car loans, house loans, which are getting more expensive, and their personal loans that they've got outstanding, and credit card loans. So I think more and more people are forcing back to work to try and cover that off, and there are obviously still jobs there. So
does that create the real problem here? Because what does that number mean for interest rates? Does that mean that really, if the Fed does it give the Fed some leeway to continue raising rates? And in that case, does it really feed back into the problem you just identified? Does that mean people then need more jobs because they've got to be able to pay these higher rates?
Yeah, I think that the Fed's going to be forced to raise. I think people the week before, they were thinking they might drop them to only raise by 50 basis points, but it appears that 75 seems to be a certainty. But it still appears, I think, that the Fed is still behind not behind the curve. They're chasing now, and maybe they're getting too far ahead, like they're reading too much into that data. And they probably should raise by less, but there's such a fear within the central bank that they, obviously were behind the curve initially, that they're going to make sure they get rid of inflation. So probably likely they come a bit too hard. But I think obviously it just means that they're going to keep their 75 is probably a lock. And the bond market's saying that they're likely to continue to raise rates in December, and to probably get to a bit over 4% by the end of the year. But we'll have to see what happens globally by that time. But with job vacancies high, people are still spending, and it's forcing up, I think, inflation expectations, at least in the market. So I expect the inflation number this week to be surprised on the upside and place more pressure on interest rates and in the market.
Yeah, right. So looking forward on that, you are expecting probably it to still be strong with the inflation. It's not just going to start easing back that you can see.
Yeah.
Because,
I
and I
mean,
was talking to you before about that.
yeah.
Sorry, just to interrupt, but with oil potentially as well, because we've seen those oil cuts pushing the price of oil back up. Now that was something that theoretically was giving us a little bit of buffer on that inflation, wasn't it?
Yeah, it was. A lot of those commodities, or not a lot, but it's definitely oil's a major input, and that's gonna affect things. But I think it's just the fact that it's got into those services areas as well, and you've got obviously unemployment. Employment numbers still pretty strong. I think you'll see in those services. I think that's where the market's going to look at, because I think the oil bit definitely feeds through and maintains. But the reason why the market fell away on the last inflation number was the fact that it was becoming more broad-based, the inflation. So therefore more entrenched in the economy. Mm-hmm. Therefore the Fed becomes more concerned and feels it has to go harder so that it doesn't become an even bigger problem. I mean, it is becoming a problem, but becomes so entrenched that they have to go very hard, and therefore, but it's becoming, a possibility as we sit here now. But oil definitely is a major. But I think that it was the services sector was, they had the inflation, you had rent that was still strong. And there's no indication that's cooling from what I'm reading, but that's so I'd expect it to still be a high number. If it comes in line, but it's still high, I think that's enough to shake the market. But there's not enough there in the economy to say at the moment that inflation has come off. I mean, a lot of people that are bullish the market and talking their own book are obviously saying that inflation's definitely, a lot of indicators are there. And I think they were the initial ones, but that's not what the Fed's saying, I suppose. Well, for those last inflation numbers said the same thing and it came that hot. So I don't think, you know what I mean? Those core things aren't changing.
If we put that together, is this idea of a soft landing still possible? Because if you look at what you've just said about that probably still being relatively hot and taking a long time to abate, and then potentially oil feeding into that or other commodities, can you get a soft landing scenario out of this?
I would say no. I think it becomes now a case that it becomes a hard landing, sort of the major. I think there's maybe a 25% chance they get a soft landing because those jobs numbers are like ratcheting down, and then so that there is less. There is more people looking for jobs starting to. There has been a shift in this one, so I think there may be a 20% chance, but I think the major probability is that there is a hard landing and I think the Fed's appears to be going that way because they think it's the only way they can get rid of inflation out of the system. So, and that they are, I think they genuinely, it appears to be, they're panicking. I think they are starting to panic about, and we wrote about that they're panicking about inflation, and as a result, they're reacting. And I think in Australia, they've sort of started to panic the other way by only raising rates by 25 basis points. So they're starting to panic about housing market collapsing and I think that he's probably may have got this more right than what the Fed, but the Fed does have a hotter inflation number. There's no doubt about that. But they're creating a lot more dislocation globally, the Fed. But that's not the US's worry. It is all about getting inflation down. And I mean, that's what sells the jobs. I mean, will help them with the election coming up.
Yes. Yep.
And the Fed will say it's not about that, but I think they got installed by a democratic government, so I think they'll be trying to do that. And I think that's what they're trying to do. It's just they've probably misread how fragile the consumer is over there. And I think there is that risk of a lot of debt over there, but they do have a lot of equity in their homes. But I think the Fed is going to have to force more than likely going to be a hard landing, and it's going to be painful for everyone.
And just thinking about that sort of domestically, I know the Aussie dollar's really come under a bit of pressure, which is what you would expect to happen in that scenario where we've taken maybe, enough is enough approach and chosen a lower number. But, that may end up being a mistake from us as well, because we may have to flip on that, I suppose. And
correct. Yeah.
And go back to, if they keep going and we're too far behind, then just smashes the dollar, doesn't it?
That's right. Yeah, it does indeed.
So what about equity markets generally? Does this mean, I was looking at that over the weekend, and we're really testing, particularly in the S&P. The Aussie was a little bit higher, but testing those lows looks like it's really a break could be imminent. Is that what happens here? Does this all result in that leg lower in the equity markets?
Yeah, I mean, we're expecting that. Yeah, I think it's getting to a point where you've got you had the issues in the UK, you got pension funds in Germany now, insurance companies in Germany now having issues as well. I mean, there is liquidation going on globally, and it's only starting to accelerate. And I think if you get that retail investor starting to panic now, and look, their weightings, and if you look at, say, Bank of America numbers of private client high net worth, they're still around 65% in equities. So I think there's a chance that we start to waterfall effect occurs now, because it becomes a feeling that there is no way out other than to keep raising rates, and that's all that's going to do is force asset prices down. That's the mathematics of it all. And China isn't going to bail everyone out because their economy is slowing as well. That was the hope of a lot of investors in Australia, that China would bail out but they bailed out the world during the GFC. They spent $600 billion, and so there was the hope that they would bail us out, but it appears to be that's not going to be happening. So, and
it might give us that sort of capitulation sell-off that gives us the green shoots opportunity down the track too, because it really has been very orderly, this sort of pullback, hasn't it? And for the scale of what's going on, maybe that makes sense.
Yeah, especially in Australia. Australia's been largely unaffected in that big, the resource end of the world, the banking part of the market. It's been, it's down a bit, but it's nothing like the carnage that's occurred in the banking and sector in the US. So the financial, yeah. So no, I think it has been orderly, and that you'd expect that to come. And whether that's the bottom or not would be interesting to see how things play out. But it'd obviously be the start of something more aggressive. And then, the Fed might panic the other way, but they are going to be in a corner, like you've indicated, that they can't, like in 2018, they can't, like during the GFC, start cutting rates. And if you remember during the GFC, I think we were printing hot inflation numbers at around 6%, even in 2008. So it wasn't until Lehman's that inflation started to come out of the system. So I know it's not as hot as what it is now, but there was still, people forget, in 2007, 2008, you were printing high inflation numbers, and then those inflation numbers eventually went when you had a severe sell-off. And I think that's the only way they can possibly get it off, because oil's going to go back up, and you got the rent issues in the US, and you've got services, people still spending on travel and going to Las Vegas, and even here in Australia with your flights and so forth, those numbers are still high. So they all feed into inflation, and electricity prices are high. So, and that's not changing until we have a major,
that actual clearing event.
Yeah.
All right. Well, thank you so much for breaking that down for us. We always appreciate
welcome.
Getting your perspective on all of this, Sim. So thank you.
Thanks, Chris.
And we'll get you in again soon.
Sounds good.
All right. Thanks, Tim.
Thanks, Chris.
Thanks very much, Tim, for being on the show. Always good to have you. And Chris, I'll see you on the next one. And for the audience, head over to the Discord channel. That's discord.gg/gold to continue the conversation. Chris will be there for the next 1 or 2 hours after the upload of this video. It's the perfect way to ask your questions, get some responses in return, and let us know your feedback. We really want to hear from you. Of course, I want you to subscribe to the YouTube channel. That's youtube.com/Ainsley Bullion for the wide range of informative videos we have 5 days a week. And while you're on the internet, head over to goldsilverstandard.com, because that's bringing gold and silver into the digital world. As we say here at the end, balance your wealth in an unbalanced world. Take care. We'll see you next time.